It's possible you missed it, but AMC stock was put on a 30-day downside watch from Citigroup. Now, what do they say and why is this complete bullshit? We'll get into it here in this video. On top of it, the street is out with a new article that says cost to borrow AMC stock jumps to over 300% amid APE's court hearing. And this number even higher today, as we reported in the last video. Let's get into these two topics, and then I want to take a look at the option chain and what investors are currently expecting for AMC. So I hope you guys are ready. We'll touch on technicals as well if that is something that you are into. Hit the like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. So Citigroup opens downside 30-day catalyst watch for the stock. Sees downside pressure in coming days. Okay. It says, let's see where they actually said. It says Citigroup is expecting a ruling in favor of the proposal. As a result, we would expect the value of AMC common units and APE units to converge. The analyst wrote in a note, given AMC's common units trade at a premium to the APE units, we would expect downward pressure on AMC shares in the coming days. That's bullshit. Complete bullshit. Why is AMC not falling here? Why did AMC actually move higher today? Well, probably because that downside has already been priced in. Now, in theory, APE could converge with AMC and there would be no downside. They would just simply converge. That's in theory. Now, why do I also think this is BS? Citi, bro, you are way behind everyone else. People are so negative on AMC. Now you want to jump on the train? You already expect the worst. Usually when you expect the worst, any glimpse of positivity can be super positive. Super positive. So I think while these guys, they're on Wall Street, they don't understand how things work in the markets, right? That's a fact. Wall Street doesn't understand. And that's why retail continues to outperform Wall Street. They specifically don't want to look past the actual convergence, right? All they're going to focus on is the convergence. As soon as the convergence is over, they're going to say, yup, AMC is super bullish. Super bullish. They just raised billions of dollars. Super bullish. Watch. This is going to happen. But at that point, by the time Wall Street is saying that, Citi or other analysts, the stock's already going to be higher. So the time to position for that is likely now or the past couple of days. That's why I've been screaming from the rooftops, the low is in. It's possible that I'm wrong, but all logical common sense and years of investing tell me that when everyone is bearish, you want to be bullish. I've said that before. But specifically, when there is so many different parts of a catalyst, and everyone's focused on the negative, the positive usually overturns that. Especially when you're faced with such a positive. AMC being able to pay down billions of dollars in debt, have billions of dollars in the bank. On a conservative note, they could raise up to $16 billion. But conservatively, paying off billions in debt and having billions in the bank. Call it $5 billion they raise. 3 times less than the max they could raise. Well, wouldn't it seem likely Wall Street would focus on that as the business just got way better? Yeah, obviously, it's going to happen. Again, by the time that happens, the stock's going to be much higher. That's the bottom line to it, right? So, that's why I think this is really BS and why it's actually a really good sign. Citi just now putting their 30-day downside catalyst watch on AMC. Usually a sign the stock's probably going to recover and reverse the downside trend, in which we have seen over the past couple of trading days so far. Now, let's move on to this article from the street. It says AMC Stock's borrowing costs have hit eye-popping levels. Court proceedings got off to a fiery start with an unexpected fire alarm. Little else of note happened on the first day. High borrowing fees indicate generally bearish sentiment towards AMC, but the stock is set up for yet another short squeeze. Says after a dramatic start to the proceedings, the rest of the day didn't offer investors much to react to. Shares of AMC closed the day flat, while APES rose a modest 1.5%. The most relevant part during the short first day of trial was a comment from plaintiff's counsel saying that they felt backstabbed by the company and that AMC had inspired a lot of passion in investors. The agenda for the two-day hearing is built around hearing out objectors to AMC's plan to convert APES and conduct the reverse stock split. However, the court will likely make a favorable decision for AMC. The special master has already indicated that he will favor denying objections to the settlement. AMC short sellers are over the moon. Amid developments in court pertaining to the drama surrounding the APES, AMC shares borrow costs are now at a 300% annualized, following a trajectory they have been on since late May. When the cost to borrow stock reaches such staggering levels, it indicates that traders have immense interest in shorting that stock. Concurrently, AMC's 300% borrowing fee also indicates a very limited availability in the supply of shares available for lending. If the court rules in favor of executing the conversion of the APES and the reverse stock split, this will result in a massive dilution of the company's float, which should in turn have a negative impact on the price of AMC's common stock. Many shorts have also been pursuing a potential arbitrage opportunity. AMC's common stock's share price currently sits at $2 above preferred stock's price, which does not make any sense since they are effectively the same asset and offer the same voting rights. Some shorts then have been piling onto their short AMC positions while taking out long APE positions, banking that the prices of the common and preferred stocks will meet somewhere in the middle. Short squeezes can turn short sellers' pockets inside out. When a stock has an extremely high borrowing cost, as in the case of AMC, short sellers could be leery of a short squeeze. Squeezes occur when the price of a heavily shorted stock starts to skyrocket, forcing short sellers to buy back their shares to cover or eventually close out their positions. This buying pressure can cause a profound increase in the stock price, as it has happened several times with AMC in recent years. High borrow fees put shorts in an even more vulnerable position by compounding potential losses in the event of an uptick in share price. And some real-world examples of short squeezes coinciding with rocketing borrow fees have happened this year. Notice in the chart below when the short squeeze occurred, borrowing fees with a yellow line were correlated with price candles. Borrow fees falling, stock fell. Borrow fees rising, stock rised. AMC's borrowing fees surpassed the incredible 1,000% mark in mid-April, effectively triggering a short squeeze that caused shares to rebound from $3.91 to $5.46 on April 13th. In mid-February, when borrowing fees hit over 730%, AMC stock rallied almost 70% to $7.61 per share. However, it is also worth remembering that a short squeeze usually requires a confluence of several factors, including high short interest, positive catalyst, driving FOMO, and short sellers experiencing significant losses over an extended trading period. I think that is the gold of this article. Besides just highlighting cost of borrow fees going up, AMC price tends to go up. It's the obviously FOMO with AMC. That's always going to be out there. People of everywhere essentially are always looking at AMC like it could potentially run again. People that are not apes, that don't give a shit less what's going on with AMC, they still remember AMC for one reason: short squeezes. That's it. A lot of money to be made, and that is also powerful in terms of potential FOMO. Now, short interest sitting at about 24%. I would argue with the option activity, you're still looking at a short interest over 30% or so if you factor in July 21st and that very large option expiration that has a lot of deep in the money puts at this point that has forced market makers to short a lot of stock. Now, the positive catalyst. Everyone wants to talk about this conversion, like I said, in a bearish light. Where after the bearish is over with, after the judge rules on this, markets will start to look ahead. And they will start to say, hey, is this bearish for the company itself? Or did the price to book on AMC actually just drop exponentially? Meaning that if AMC raised, call it $10 billion of capital, well, if the market cap is $4 billion, AMC, if they can get to a place of profitability or just break even, well, they would have over 2 times the amount of cash as the total value of the company. Shouldn't that push up AMC? Shouldn't that alone make AMC stock rise? Make this make sense for me, okay? If I told you that I had a car, right? Beautiful car. This car is $50,000. Call it a Tesla Model Y. For $50,000. Brand spanking new. Or what if I told you I have another car, same exact car, $50,000, brand spanking new, but that car has $150,000 inside of it? Which car would be worth more? Obviously, the car itself would have the same value, aka the same value of AMC's business, right? Of, people going to the movies, buying candy, buying popcorn, all of that. But what's actually going to be, have more value as a bundle? The car with the $150,000 in it. Because it's essentially 3 times even the value of the car itself. Same story with AMC. Which one would you pick? I mean, it's pretty clear here. That should add to the value. Or maybe a better example would be if you had those 2 cars, both worth $50,000, one with $150,000 in the car, and I told you you could buy the car with the cash for $100,000. Wouldn't you do that? Or would you buy the other car for $50,000? Come on. This is pretty logical, okay? As long as AMC was free cash flow positive or at least neutral. Now, in that same example, if I said that car payment, yeah, you could buy it for $100,000, but the car payment's going to be $3,000 a month. Maybe it would make sense to go with the car for $50,000 because you're going to run through that extra $50,000 in cash in no time at all, right? 12 months, you're going to be negative. Almost. So that's the way that I look at it. I think that has to be a positive thing for AMC, no matter which way you put it. Even if AMC raises $5 billion in cash, well, now they have more money in the bank than the company's worth. That should be a positive thing. Okay, so that's kind of my example here to leave with you guys off with. Now, let's go ahead and look at some of the option activity as well. I do want to run through the cost of borrow fees if you have not seen the last video. We do have estimated short interest of free float at 23.28%, $530 million worth of short positions currently on AMC, 189 million shares that are currently out on loan. Days to cover sitting at 8.88, which is up 56% in the last 3 months. Cost of borrow fees 181.15%, and utilization sitting at 91.5%. Cost of borrow fees for AMC. Cost of borrow average at 940%. Cost of borrow max at 1,060%. Cost of borrow minimum at 0.35%. What's actually interesting right now is even though markets are closed, and they have been closed since 1 p.m. Eastern Standard Time today, cost of borrow fees continue to increase. Yeah, I really can't make this up. This number just came out from Interactive Brokers. Just came out. Look at the last video. I posted that video after the markets were closed, and it was 498%. Well, now the cost to borrow rates from Interactive Brokers is 577%. Someone is either trying to get their hands on some stock in AMC or someone's expecting the stock to move huge soon in the upcoming future. So, let's go ahead and take a look at some of the option activity. If we take a look at the option activity, expiring, let's look at July 21st. Again, expect this to be pretty negative. So, you have open interest at the $10 call at 290,000. You've seen volume today of about 3,200. $10 put, this is the big one that's driving a lot of that shorting from the market makers, is seeing open interest at 261,000. Volume on the day of over 2,000. This $10 put is driving a lot of shares to be sold short. If you look at 261,000, we go ahead and pull up the calculator here. 261,000. Pretty simple math here, but you know, I'm not going to try to do it. Times 100 for shares, right? Every one option controls 100 shares. That's 26 million shares that likely are currently sold short. Well, that's just based off of the $10 put. When you're seeing volume of 14 to 15 million on most days, that is sizable. So if you do start to get AMC that goes higher and some of those break evens on those $10 puts start to go against the buyers of those puts and the market makers start to actually make some money on those, well, or at least get in the green, you probably get some more upside to AMC as well, and in a weird way, could fuel a reverse gamma squeeze. So, ladies and gentlemen, hopefully you learned something out of this video. If you did, hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Thank you for watching. Enjoy the rest of your day, and happy 4th of July. I will see you in the next one.